Okay, good afternoon, everyone. Thank you so much for taking the time, especially in the middle of a busy Thursday afternoon. So that's most important. And like I always say, we have to walk away with nuggets. You got to write down some notes, use your notes app on your phone or computer, whatever it is. But please, that's most important. I want to make sure every minute is maximized with us today and you walk away with a sales idea, especially with this concept, because these are monster cases. So, if you have one contact, literally one contact, okay, and yeah, you understand the strategy, okay, but maybe you know enough to be dangerous, and Mary gets involved and helps you. This will and could change your year. One case, one contact, one person, one guy or girl. That's it. Okay, and I wouldn't take this lightly. This is very serious. If you're focused on large estate planning cases, you're going to walk away with some great nuggets. If you're focused on term insurance or final expense, okay, that's okay too, because it takes one person. And I don't say that lightly. I'm going to share a case study at the end. One of our agents who's actually on this call today walked away with $120,000 of commission because of one contact. Okay, so yes, it's that simple if you have the right connection and or relationship. So very important stuff. We're going to talk about small business owners in general. What we wanted to do today, if you were at our expo, okay, you witnessed Mary Reed, our keynote speaker, who did a phenomenal job, by the way. We had one small issue, and the small issue was we ran out of time at the end because she has a lot of ideas, a lot of strategies, and great information. So I told Mary at the end, we're going to literally schedule a part one and part two right after the expo, and that's what today is about. We're focusing on part one, okay, which small business owners or business owners in general, and then we have a follow-up part two, which is focused on distribution solution strategies. So very cool stuff. This is a great opportunity for you to learn. Mary's also an author. She's got, I think, 4 or 5 books out now that are amazing. And what we're going to do today is we're giving away 2 copies of her book and the new Amazon Fire 8 tablet to whichever agent answers our question correctly and first at the end. Okay, and the answer has to do with one of the slides that's coming up in a few minutes, so make sure you're paying attention and you stay on until the end. Okay, so here's what's cool. So if you're a Levinson agent, you're active with us, which I know 99% of you are, which is great. We have a complete turnkey platform focused on business owners, okay? And of course, Mary's strategy is part of our platform that we offer at no charge to our agents. The only caveat, and I just want to put this out there in the beginning, we're going to talk about it soon, but you do have to be appointed with Levinson, with Life of the Southwest, and Lafayette Life. Okay, and you'll understand why at the end, but Lafayette Life has a more conservative whole life approach. Life of the Southwest has a indexed UL with living benefits that works great with Mary's strategy. So she does use those 2 carriers, those 2 types of products. Very important stuff. If you're with another IMO, no problem. Just let us know. We can get you transferred over. And of course, you can leverage the cash for contracting or leads for contracting incentive, and we match or most of the time beat your commission. So there's no issue there as well. Okay, let's move forward here. So what I wanted to talk about, our expo, in fact, our 50th anniversary at Levinson and Associates, 1972 to 2022. And we celebrated this at the expo a few weeks back. And I'll tell you what, especially considering there's a pandemic still going on out there, we had a record turnout. So I wanted to just take a minute and thank all of you for attending. Okay, if you did not get a chance to attend, we literally have a expo section on our website that we filled up with all of the latest brochures and material from the expo, from each presenter. So you can check that out when you can. We're also going to send out a thank you email to every agent that's listening right now. We'll include the link for all of the presentation material and some videos so you can check out everything just like as if you were sitting there on Friday, April 8th with us. So make sure you take a look at that when you get a chance. Okay, let's move forward. I don't want to waste any time because Mary has a lot to talk about, and I cut her a little short at the expo, so I want to make sure she gets in every minute. And again, most important, that you all have some new sales ideas here, right? And have some new stuff to talk about to your friend that owns a business. It doesn't even matter. It could be a 7-Eleven franchise, BurgerFi, whatever the case is, okay? One connection is all it takes. This is what's new at Levinson and Associates. I'm just going to run through a couple additions and what you should be focused on. So if you move over to the right-hand side, that Ringy CRM tool is a game changer, folks. If you're a GA or an agent right now, okay, and you're obviously working on prospects and leads, I'm telling you, this will change your business, and we have an exclusive 30% off discount for Levinson agents. I have never seen anything like this in my life, and I'm not saying this lightly. So what I'm trying to tell you all, I'm not selling you anything here. This is about Mary and distribution solution strategy, okay? But what I'm saying is, if you're an agent out there and you're not using Ringy or something like it, you're falling backwards in 2022, okay? And when you see the launch webinar, and we'll include it in the thank you email, you'll understand what I'm talking about. Basically, what this does is maximizes every single lead or contact to make sure that either that person says, hey, Bill, I'm not interested in life insurance, and they opt out, or they say, hey, Bill, I'm ready to talk about insurance or an annuity, okay? And you will know by the time the system runs through the cycle with each lead on autopilot, you're going to know one way or another, okay? And if you play the numbers game, just think about 500 contacts, okay? 5 to 10% return on the average. That's 50 to 100 new clients that you just made with a tool like this, okay? So just do the math and think about what can happen from a platform like this set on autopilot. Okay. All right. We have a few other incentives right now. Instead of diving into each thing, what we're going to do is include this in the thank you email as well. You'll get that tonight before we leave. If you don't receive this, it's probably in your junk folder, or we have the incorrect email address for you. So call in. Please let us know. Okay, without further ado, I want to jump right into our feature presentation by Mary Reed. Sit back, relax, plenty of notes. We have plenty of training material to get you comfortable, but you're going to learn a lot the next 50 minutes here. Mary, you there?
I am still here. Yes, thank you very much.
Okay,
all right, so
perfect.
Thanks for that
Thank
great
you.
introduction. And you've got lots of stuff going on, clearly. So we're going to make good use of this time today, I hope. I know for those of you who were at the expo, I talked to a lot of you afterwards, and it was like, I know it was like a fire hose coming at you, but lots of questions, lots of interest. So I'm glad we're having this opportunity to do some follow-up between this session and the next one we're going to do. So today we're going to talk about approaching those business owners. And the qualified plan arena of getting them deductions and getting the money into the plans. There's lots of opportunity there. Very few people have these conversations with the business owners, so including their CPA, because they're not equipped to talk about all the options, let alone actually design a plan for that employer. So this is a great opportunity. There's a niche there, there's an opportunity, there's a need, and you have the opportunity to fill that. So I would hope some of you will take advantage of that. Also, I'll just toss in right now, here we are in April of 2022. We are still putting in plans for businesses who want deductions for 2021. So keep in mind as we go through this, if you have clients who are business owners and they have not filed their tax return, they went on extension, they still have an opportunity to do this, and we can save them some tax dollars for 2021. All right, so let's jump into the content. So we have the Secure Act. Just, there's been a lot of legislative activity. I mean, there always is, but there's been a lot in the last 5 years, and a lot of it has touched the world of qualified plans. So the Secure Act, everybody knows it pushed the required minimum distribution date on the the qualified distributions back to age 72. But that is also the change that extended the adoption deadline for the qualified plans, which is why we can still do plans for 2021. Now, this was signed into law in 2019. It is astounding to me, at least how many CPAs are still unaware of this. They don't know that their clients can still set up plans. So in addition to clients, if you work with CPAs and you know CPAs, you might want to have a chat with them about any business clients they have who are on extension who could benefit from a deduction, because we can still give it to them. All right, but we had some other changes before that that are still affecting business owners. So I just want to spend a brief moment talking about the Tax Cut and Jobs Act of 2017. It seems like ancient history at this point, but that was the change that brought us 199A. So what is 199A? 199A is a 20% deduction of qualified business income that was given to pass-through entities. So this was kind of, the C corporations got a 21% tax rate. The rest of us didn't get really any reduction in our taxes. We went from 39.6 to 37, not the same as going down to 21. So what they gave the business owners with the pass-through entities was this 20% deduction. Now, businesses that are in the service industry, however, lose that deduction if their income is over the threshold. And they define that income as total household income. So it's not just what that business owner is bringing home, but what their spouse is bringing home as well if they're married. So this put a lot of these business owners in these service businesses at a loss. They lost that 20% deduction. And a lot of our clients that we deal with are in the services industry, doctors, attorneys, accountants, actuaries, consultants, all these people are in service industries. I would say probably for the majority of the people on this call, and certainly for myself, almost all my clients are in the service industries. I have very few clients that actually manufacture something. So a lot of our clients were affected by this. So it seems like ancient history now, but people are still wrestling with this, and a lot of people don't know that there might be a way to get their 20% back that they lost. And even the CPAs, some are more proactive than others, but a lot of them are not really looking into this. So some of you may remember this when I talked down in Florida. This is a client of mine. They came to us with a $700,000 taxable income. They were way above the threshold. The threshold's about 400 and change. Let's just call it 400,000. It goes up with cost of living. Doesn't matter right now. It's in that range, right? So they're a married couple. So they did not have the 20% deduction. Now, a very common conversation with someone like that might be, well, you could do a SEP, because there's only two of them. There's no employees. You could do a little 401k plan. Well, that's nice, but it wouldn't get their income below the threshold. You can only put so much money in those plans. So instead, we gave them a 412E3 defined benefit plan, annuity only, and that gave them a $405,000 contribution instead of, back then, last year would have been $58,000 going into a 401k. This year it's $61,000, but we got them $405,000. So that brought their income down to $295,000, which now brought them below the threshold from 199A. So now they picked up that deduction as well. We took their taxable income from $676,000 down to $212,000, and took their tax bill from $250,000 down to $50,000. Now, for most business owners, if they knew they could do that, I think they would do that. Now, obviously, they have the cash flow. I have to have the cash flow to make that happen. This couple did. So it may be the dollar amounts will vary from business to business depending on how much they can afford. But I have not seen a big influx coming in from CPA saying, my client's got income over the threshold. What kind of a deduction can we give them to get them under it? Which leads me to think they're not really thinking outside the box here and thinking about those tools, but you can bring them to the table and say, well, maybe we can get that income under the threshold so they'll benefit not just from this deduction, but from another 20% as well. Some other reasons to talk qualified plans with your clients. Here's some, kind of scary statistics. Average 401k balances by age. Look at the 55 to 64 age category. Those are people creeping up on retirement. The average 401k balance is $197,000. The median balance is $69,000. How long do you think you can retire on $197,000? I don't care where you live in the country, it's not going to be very long. Some places it'll be months, some places it might be a couple of years, but it's not going to be all of retirement. And what I have found in working with business owners for 40 years is that even the ones that make a lot of money don't necessarily have more money put away for their retirement. Business owners tend to either spend the money or pump the money back into their business. I had a call just this morning. Here's an example. I got a call this morning from someone. It's a 65-year-old business owner. Never put in a qualified plan. Now he's finally decided he wants to retire in 3 years. He wants to know how much money can he put away in a qualified plan. We can put in about $385,000 for him a year for the next 3 years. Now, that's still not going to be enough, but at least it's a nice big chunk. But he's not unusual in that he hadn't planned for this. And most business owners will tell you their plan for retirement is to sell the business. Well, maybe that will work and maybe it won't. All right. So here's another one. If we look by income, right? So if with annual income of 100 to 150,000, you can see down there in purple, the average balance is only 177,000. 150,000 above, it's only 298,000. We would expect these numbers to be much larger, but in reality, they're not. So if we're talking to that business owner like this gentleman this morning who's very successful, he's making $3 million a year, some people are savers and some people are not. So we can go in with a qualified plan and accomplish multiple things for them, get them the current deduction, put the money in a place where it's protected from creditors as well, so it's in a safe place, and accumulate money so they can actually retire when they want to. Just some more statistics that play into this. A healthy 65-year-old couple, this is from 2019, would need $390,000 just to cover their out-of-pocket medical expenses in retirement. Add that to whatever the estimate is of what that couple will need to accumulate to live the comfortable retirement that they want. Companies with 10 employees account for 96% of the businesses out there and employ 47% of employees. And they are the least likely to have any qualified plan in place. It's a very small percentage, and when we get to defined benefit plans with like the cash balance and 412 plans we'll talk about today, it's about 1% of businesses have those plans. So there's definitely room out there. So I talked about that business owner, how are they going to retire? Usually they'll say, I'm going to sell my business, right? So retirement income can come from whatever they get from Social Security. If they have personal savings, to whatever degree they have that. The sale of the business. Well, what if it's not a good time to sell the business? What if the value of the business is the sales is the owner, because they drive all the sales? Well, if they walk away, is there really anything left to sell? What if their child is going to take over the business? How are they going to buy them out? There's all kinds of things that are, dangers fraught with that strategy. So in those good years, if they had put in a qualified plan, taken advantage of those deductions and put the money away, and now when they decide, I want to retire, fine, try to sell the business, get what you can, but they'll have this other pot of money so that they actually can retire. Right. So here's my pyramid. You all saw this at the meeting. Right at the bottom of the pyramid are the plans with the largest contributions. Those are the defined benefit plans. In the middle, we have the 401k and profit sharing plans. Still good plans, but much smaller contributions in terms of how much we can put in. And then, of course, the distribution strategy is at the top, and we will talk about that on our next call. So what I want to focus in for the kind of the rest of our time today is plan design, because this is really what it comes down to. When we're talking to an employer about putting in a plan, Yes, it will enhance employee loyalty. It may help attract employees, all those kind of things. And some employers care about that. Many don't really. But it will reduce the company's tax obligation. That is usually the first and primary driving factor. Everything that goes into that plan will be tax deductible. It will grow tax deferred as long as it's in the plan. Anything that is contributed is not currently taxable to the individual that is contributed for. And we can also add income tax-free death benefits in the plan as well. So it's all about the tax advantages, and that's almost always where the conversation starts. But it does save money for retirement as well. And so sometimes that is the conversation. And ultimately, depending, getting the money out is a whole nother plan. But they can delay taking distribution of that money until they're 72 and let it grow until that time. And then, of course, they will have to pay taxes when it does get withdrawn at whatever tax rate they're in at that time. And getting that tax bill down is a conversation for our next meeting, conversation for another day. All right, and I talk about the creditor protection, and this is important to people and not particularly important to others, but it can be important that any money that a business owner has is subject to creditors. Any money that they have as their personal assets is subject to creditors. So everybody hopes that bad thing isn't going to happen, but sometimes it does. Usually something unexpected, and maybe you're a doctor and there's a malpractice suit, whether they win or not. Maybe you're in the construction industry and you get caught up in the volatility of the housing market. It could be any number of things. The money that goes into a qualified plan is fully protected under federal law and under ERISA as long as there is one rank and file employee in there besides the owner. So when that happens, nobody can touch that money. The only people who can get to it are the IRS and a spouse. So this is a nice, safe place to move money from the business balance sheet to your personal balance sheet, in effect, but have it in this very safe holding place in the meantime so that no one can take it away. All right, so we'll start at the beginning again. We did this at the meeting, but this is a good place to start, right? If we had a one-person business, and that person's got a taxable income of $175,000, that puts them in a 24% federal bracket, and I've had a 6% state bracket. They'll be paying $52,500 in taxes. And if they did that for the next 25 years, if everything stayed the same, that's $1.3 million in taxes they'll pay over those 25 years. Now, they're probably upset about the $52,500. If you show them $1.3 million, they're really depressed. So we could put in a qualified plan for this person. This would be a little solo K. Have a salary deferral on last year's numbers of $19,500 plus a $38,500 profit sharing contribution. And those deductions of that amount would save them $17,400 in taxes. So if I did that for the next 25 years, that means I would have gotten to hold back $435,000 that we could put to work rather than paying it out in taxes. 25 years out, if we grow that money at 5%, just the tax savings, we did contribute money above that, but just looking at that $17,000 in tax savings, that would grow to about $775,000, assuming 5%. Now, if they didn't do the qualified plan, they lost it to taxes. They paid $435,000. They didn't get to keep it. So here's the choice. Would you rather pay the $55,000 or maybe have another $775,000 for your retirement? Which would you rather do? Well, I'm going to have to pay taxes on that when I take it out. Yes, you are. We're not wearing the orange jumpsuits and going to jail for tax evasion. Yes, you are. So what tax bracket are you going to be in? Well, I don't know. Well, I don't know either. But let's say it's a bad case scenario. Let's say you were in a 50% tax bracket, so you lose half the money. You lose half of money you wouldn't have otherwise had at all. At least this way you have the money, whatever the tax rate is. If you don't do this and you pay the taxes, you don't have anything. I think that's a better deal. All right, so now it gets to the tricky part, because what if there are employees? We don't want to contribute for the employees, is what most business owners will tell me. And I understand that. And, occasionally I do get the employer who wants an employee benefit program. Once in a while I do. Good for them. We can design that for them and be as generous to those employees as we want. The IRS is always happy if we give more to the employees. But if I get that business owner who doesn't want to give to the employees, now we're really into the world where this all comes down to plan design. Can we get this plan design efficient so that those employees are not costing that employer anything? And the way we do that is with design. So here's the plan. These are still 2021 numbers. These aren't updated, but that's okay. It just changes the numbers a little bit. I have my 2 owners, the child in the business, and 2 employees. We've got $730,000 of payroll. Here's a plan I could design for them. I give each of the owners $58,000 was the maximum last year. This year I could move that up to $61,000. But I have to give the employees $9,000 and $6,000. Now, this is a very common size business that would be sitting with the CPA when they're doing their taxes, and the CPA says, oh, you want a deduction? Let's do a SEP. Let's do a SEP for last year. It's free. We just fill out this form and you have a SEP. Well, that all sounds really good, but in that SEP, we have to give these 2 employees $15,000. Quite a bit of money. Now, the owners are still coming out ahead, but it's still quite a bit of money. But what if instead we gave them a profit sharing plan, and now instead of giving those 2 employees $15,000, we're only giving them whatever this about. It's about $6,000, right? When we add that up, would you rather give your employees $15,000 or $6,000? You get the same amount either way. Probably rather give them $6,000. Well, that's what we can do by going to a profit sharing plan instead of a SEP. The CPA probably may or may not bring this up, but I can tell you the CPA cannot design the profit sharing plan. They don't have the software, and they're not going to do it on a yellow pad. Pension design software is very expensive. But that's good for you because we have that software. So if you have a relationship with a CPA so that they can offer these options to their clients, we run the plans for them. We become their back office to do that. You become the financial advisor who's going to write the plan with the product and have the relationship, and the CPA does a good thing for their client. Now, if we did this plan, we've got a total plan contribution of $125,750. Tax savings at a 30% tax bracket would be $37,725. So out of pocket, it's only costing them $88,025. That's what it's costing them, but the family members are benefiting from $119,750. So if it only costs you $88,000, but you get the benefit of $119,000, you came out ahead $31,725. The difference between the $31,725 and the $37,000 that we actually saved in taxes went to the employees. But what did they cost us? It didn't cost us anything. The refund, the savings, the IRS really paid for them. And I still came out ahead $31,000. If they were being really stubborn and said, I'm not going to do anything where I have to contribute for my employees, okay, that's your choice, but that costs you $37,725. Instead, we can give your employees a little benefit. They'll like it. They'll be happy. They might stay longer. And you're going to come out ahead $31,725. Why would you not do that? Now, here's a look, just a little talk about plan design here. These are all profit sharing plans. So they all have the same contribution limit. And in all these plans, we can get the owner to the same limit, $58,000, because it's last year's numbers. But design makes the plan efficient or inefficient, right? So here's this proportionate to pay is what that SEP would look like. There's that $9,000 and $6,000 going to the employees. SEPs are free, but they're not necessarily cheap. This is called permitted disparity. This is integrated with Social Security. Now we get those contributions from $9,000 down to $76.98, from $6,000 down to $5,132. Remember, Pat and Chris are getting the same thing. Now, it's not a huge reduction, but it saves a few $1,000s. I would think the business owner would probably rather do that. Then we could go to age-based. In an age-based plan, it favors anybody who's older. Now here, Pat still gets $58,000, but Chris only gets $41,000 because Chris is younger, driving the numbers here. We get this employee really low, down to $562, but this employee is 61 years old, so they're still up at this $6,500 category. Not terrible. But if we go to new comparability, that's where we get the most control. We even Pat and Chris out, and that's where we get this $2,250 and $3,750 down for the employees. Now, you don't need to know this. The CPA doesn't need to know this. We need to know this. So all we need is to know what's the budget of what they think they want to spend or can afford to put into this plan. We need the census, and then we do the design to find the type of plan and the design in that plan that is most favorable for that group. And we will come back with whatever that design will be. I can tell you most of the time it will be this one because that gives us the most control. But if you don't have someone doing the job properly, for example, no offense to the CPAs, but if they're only talking to the CPA and all the CPA can do is assess, then they're really not getting the full picture. And they're not making the best choice. We can help them make the best choice. You can help them make the best choice. Now, if they want to go even further, this is when we start to walk into the world of defined benefit plans because we're not limited to that contribution number, 58,000, now 61,000. We do have a benefit limit that right now is a lump sum is running at about $3.2 million that we can fund to, but the contributions can be whatever is needed to get there. Now, here's a traditional defined benefit plan for the same company. And now, for Pat, again, age will drive these numbers. The contribution is $199,000 instead of $58,000. Chris gets a $161,000 contribution versus $58,000. This employee, that 61-year-old, it's a $22,000 contribution, but they will have to vest in that benefit over 6 years. And this employee is only getting $858 because they're young. Much, much bigger numbers. And if the employer really wants to go there, they could do both of these plans together and double up. So when we step into the world of defined benefit plans, we step into a different world. Here we have some certainties, right? If you're in a 401k plan, you know how much you're contributing. You have no idea what your retirement benefit will be. None. It all depends on the investment returns within the plan and how much is put in over the years. You could be in a very good position today and you want to retire in 5 years, and somewhere in that next 5 years, the market drops by 50%, and now you only have half the retirement benefit. That can't happen in a defined benefit plan because in a defined benefit plan, your benefit is defined. The employer has to contribute to make sure that that money is there to pay that benefit, but your benefit is defined. So it brings some certainty into the world. We know what the benefit's going to be. We can design this plan to have guaranteed return if we want to, guaranteed death benefits, very predictable costs. We've got the protection from creditors, and of course, we have the current tax deduction. So life insurance, we can put life insurance in any of these plans. And I'm sure those of you who are at the meeting remember this slide because not so many people put up a slide that says this. We can have life insurance in any of these plans, but it becomes particularly effective when we get into defined benefit plans because we get very good leveraging on the use of the dollars. And of course, the death benefit will always be paid. Someone will get that benefit sometime. All right, so here's my little 412 plan. Now I just have 3 people in it. If we did this plan, a 412 plan is a defined benefit plan. We have 4 types of defined benefit plans. Traditional, those have been around since the 1930s. What a traditional defined benefit plan does is it defines a benefit at a retirement age. Under the current rules, that retirement age can be no later than 65 and no earlier than 62. These are the kind of plans, our parents and, for some people, grandparents were in. It might say you will receive a benefit at age 65 of 20% of pay, or you'll receive a benefit of age 65 of 1% of pay for every year you were employed, those kind of things. Then we have fully insured 412E3 plans. Same rules, all the types of defined benefit plans have the same benefit limits, the same retirement age requirements. It's just how the benefit is defined and how it's funded that changes. 412 plan is just like the traditional defined benefit plan, but 412 was created in response to the Depression by the government, because what 412 plans do is guarantee everything. A traditional defined benefit plan can be invested in anything, pretty much anything. A 412E3 plan can only be invested in level premium annuities, and it can have life insurance. It does not have to, but it can, and if it does, it must only be whole life insurance, and those two products must be from the same company. There are only 4 companies that are solidly in the 412 arena right now. There are a couple of others that are dabbling, trying to get back in, who got out years ago and trying to get back in. I don't count them yet because I'm not convinced their products comply. Of the 4 solid companies, number 1, you have National Life. Number 2, you have Lafayette Life. So those are 2 companies you deal with. They both have excellent 412 programs. American National and Security Mutual would be the other 2 companies. But Lafayette and National Life both have excellent programs. These are National Life numbers on the screen. So the benefit you get by going to a 412E3 plan over a traditional defined benefit plan is that there's no market risk. Everything is guaranteed, everything is reliable, everything is predictable. It'll be very consistent, and the numbers can be very high. So here you can see if we just did annuity only, we have a plan contribution of $555,000. Now just think about that for a second. This is a tiny little company. 2 people and, a couple that owns the business and 1 employee. I doubt that whoever is giving them the current advice would say, we can get you a $555,000 deduction if they need it. If they want even more, if we put life insurance in this plan, remember this is whole life, here's the death benefits we're buying for everybody, it brings the plan contribution up to $723,000. Now, that may seem like a lot of money for this little company, but some little companies like this have that kind of cash flow. Imagine that this is a sub-S company, and this is what's on their W-2, but they have another couple million of pass-through income. They might like to see a $723,000 deduction. So they're only contributing $10,000 for the employee. The tax savings here, I'm assuming a 35% combined rate here, would be $253,000 in tax savings. And where are they giving the money to? They're giving it to themselves. They're not giving it away. They're just moving it from one pocket into the other and saving themselves $253,000 in taxes. Now, when we added the life insurance in this design, it increased the plan contribution $168,000. Now, that is all deductible as plan contribution, so we take off the tax savings. Out of pocket, it costs them about $132,825. I've had employers add the insurance just because they wanted the maximum deduction. All right, nice, they got the benefit, but that wasn't the driver. They wanted the deduction. All right, so it's costing out of pocket about $132,000. The premiums for these 3 policies are $333,000. For just the 2 owners, it's $327,000. So if just the owners wanted this insurance, they had some need for the insurance, you tell me where else you could pay a $327,000 premium for only $132,000. I don't know anywhere else you can do that. Maybe in premium financing. But not everybody's willing to go down the premium financing path with the finance. Maybe other than that, I don't know a way to do that. This is a way that they can accomplish that. Now, I've got them adding these very large amounts of insurance. We have it to the maximum. Maybe they don't need that much, so maybe they just want enough to guarantee the benefit they're funding. So maybe you lower the amounts and the increase in cost is even smaller. And when we get down to really low amounts, I've seen plans where adding the insurance barely increased the expense of the plan. The other thing, because everything is guaranteed in a 412E3, as I said, it's very predictable. So employers can budget for this contribution. Here's a comparison doing the same benefit formula, the same benefit plan for a 52-year-old rather. We're funding to the same benefit over 10 years. In a traditional defined benefit plan, depending on how our assets perform investment-wise will affect our contribution. If the assets make more money than anticipated, we'll be able to contribute less. If they lose money, we will have to contribute more to stay on track. This gray bar represents the history of the contribution that would have had to have been made to this plan over the last 10 years based upon the actual returns of the S&P. But the blue line represents the contributions to the 412 plan, because there we have the guarantees, so we don't have any losses and we're funding based upon those guarantees. And so, yeah, it's not as exciting. You know, it's real plain vanilla. You know, it's not sexy and it's not exciting. We have guarantees in the contracts, but it's a nice level contribution that they can rely on. All right, and lastly, we're going to spend just a little bit of time, a few minutes, 5 minutes or so, let's talk about cash balance plans, because these are the hot plan of the moment. We are writing a lot of cash balance plans and a lot of 412 plans these days, both. We're writing a lot of both, very few traditional defined benefit plans. And the thing about the cash balance plans is it's all about the control. As I said, there are 4 types of defined benefit plans, right? The traditional, the 412E3 that's fully insured. A third type is a variation of the traditional. If we have more employees, we can do the same plan as a traditional, but we can have different benefit formulas for different groups of employees in the same plan. Same rules, works the same, looks the same, except where we might have more than one benefit formula. A cash balance plan sort of does the same thing, except here we define the benefit as a current contribution credit. So we're defining the benefit in current value, not some value down the line at a retirement age. And so it's a current contribution credit that each employee will be given each year inside the plan. They don't actually get the money, but it's credited to their account in the plan each year. So simplify it. Let's say if someone got a contribution credit of $10,000 and they stayed here for 10 years and nothing changed, they got $10,000 credited every year. When they left in 10 years, they'd have $100,000. Now, there would be something over the $100,000 because they would get an interest credit each year as well on top of that. So I don't know what that would be, but they'd have the $100,000 plus whatever the interest credits were. The beautiful thing that gives us so much control in these plans is we can put each employee in their own group and give different groups different rates of contribution. So we pick and choose to some extent who we want to give the most to and who we want to give the least to. Now, it's not completely arbitrary. We have to pass testing to make these plans work, but we have quite a bit of leeway. So people will refer to these as a hybrid plan because they are defined benefit plans with the same limits, but they look like defined contribution plans because you see this contribution credit in an account for that employee. So some people find them easier to understand in terms of employee benefit, but as I said, it really comes down to the control. And these plans can include life insurance just like any other plan, and we do lots of these with life insurance. But because it's a defined benefit plan, even though that contribution credit, there's an account for that employee, it's on paper only. The funds supporting that account are really behind the curtain. There's one pooled account for the plan. So the participant's benefit in my little example there of $10,000 does not change whether we've earned 10% on the money or lost 10% on the money. They still get their $10,000. That risk of the investment performance is on the employer, just as it is in any defined benefit plan, where they have to contribute more or less each year to make sure that that benefit is funded. So who's a candidate here? All the defined benefit plans, the candidates here are companies that want a bigger contribution than that currently $61,000 a piece they can do in a 401k or a profit sharing plan. They want more than that. And when a cash balance comes into play, usually is when there are employees in the plan. You know, if we have an owner only, it's easy. They get 100% of the money no matter what we do. But as soon as we have employees or maybe partners of different ages, the cash balance usually comes into the conversation. So we can also, we usually do these plans in combination with a 401k plan because we get the best leveraging that way. So typically, if you were to come to us with a client and we think it's a cash balance candidate, we're going to come back with a 2-plan design, and that employer will actually put in 2 plans. And by the way, if we're putting insurance in the plan, there will be insurance on every participant in both plans. So there will be 2 policies on each participant. So here's my example. All right, so this is a real case that we just did recently. And it's a good example of a cash balance plan. Our owner here was 55, currently still is 55. We just did this plan, making $200,000. Remember, they might make significantly more than that. That's what's on their W-2 if they're a sub-S. Their spouse is on the payroll for $45,000, and then we have an employee who's age 50. It would be easier for us if they were younger, but they were age 50. This is a real company, making $65,000, and a 24-year-old employee making $35,000. So what we do first when we design this plan is we start with the cash balance. We're able to give our owner who's making $200,000 a contribution credit each year, right? This is a yearly amount of $204,000. That's 102.4% of their pay. So clearly, right off the bat, you can see we could never do that in a 401k plan. We're limited to 25% or $61,000. The spouse who only makes $45,000, we were able to give them $166,000 and change, 370.4% of their pay. The 2 employees get 2.5% of pay. Now, that doesn't pass our testing. That's just where we start. Now we go over to the 401k side of the equation. Everybody can make salary deferrals. I just put one in for the owner. I don't know what everybody else is going to do. Everybody can defer whatever they want up to the maximum as well. We made this a safe harbor 401k to make sure that our owner can defer the maximum, because we have to give this 3%, this is 3% of pay, to everybody anyway to pass our testing. And then we go to the profit sharing and say, okay, what do we have to give to everybody that's left to get past our discrimination testing? Now, keep in mind, right, the IRS has lots of rules about discrimination testing. In any qualified plan, you're not allowed to discriminate against the employees. But as with all government things, their definition is not the same as the common sense definition. So by definition, this plan is non-discriminatory under the IRS rules. This plan passes all the testing. We're giving our owner 124.4% of pay. We're giving the spouse 375.4% of pay, and each employee is getting 9.5% of pay. This passes non-discrimination testing. We have a total plan contribution here from the employer of $393,000. When we add the salary deferrals in, we're up to $419,000. So this is all deductible. This is a nice $393,000 deduction for the business, plus the salary deferral would come off their personal income. 97.6% of the contribution here is going to our 2 owners. Only 2.4% is going to the employees. There is no other plan type that could accomplish this the way that this cash balance plan can. Mind you, if they want to be really nice to the employees, we can always give them more. The challenge is how to give them less, and this is how it can be accomplished in a cash balance plan. Come on, slide, change. Okay. And this is another one, again, this is another way to use cash balance. And I had this conversation actually with someone just today also. You know, okay, so if this year is a good year, great, I want the deduction I put in the plan, but I don't know what next year is going to be. What if I don't have as much money? The solution for this couple, this was a couple who owned the business. They had no employees. They were having a very good year. They were paying themselves $150,000 and $60,000. So we designed a plan. Here are the contributions credits. We wanted insurance in this plan only on one of them. The other one was uninsurable, but we did put this policy in the plan. And we gave them a recommended contribution amount of $246,000. But if we go down here to a further analysis, the actual minimum they'd have to put in is $166,000, but they could put in as much as $303,000. So let's say they put in the $303,000. Now they get to, this was 2021. Now they get to 2022 and they're not making as much money. Any defined benefit plan is a commitment of contribution. And sometimes people are uncomfortable with that commitment. So what we can do here that we can do in a cash balance that we can't do in any of the other kinds of defined benefit plan is this is an annual contribution credit, right? So this is a percentage of pay. So if they want to reduce, and this is a corporation, they happen to be a C Corp, but the same thing would happen with an S Corp. If they want to reduce their contribution next year, just reduce their W-2, and it will reduce by the same percentage because it's a percentage of pay. If they wanted to drive it up even higher, they could pay themselves more on the W-2. So it's an added control lever they get on the contribution for business owners who can control what they're showing on their W-2 as another lever to control that contribution. So where do you look for these opportunities? We're looking for small businesses. Usually when I say small, less than 10 employees, the fewer the better. One-person plans are great. We give everybody the business owner. They want large deductions. They're seeking that deduction. If they're looking to save for retirement and they're behind, this is a way we could put away about $3.2 million for them. Depending on how many years, we could do that over 10 years. If it's 5 years, that number will be cut in half. Maybe the creditor protection is important to them. And this is also a way, if we have a younger generation buying out an older generation, we can use the defined benefit plan to shift money out of that business to that older person without immediate taxation by doing it inside the defined benefit plan, which will always favor people who are older. All right. So what do you do if you find somebody? You identify, someone who's a candidate. We have a fact find. I think Bill's office had sent it out to everyone. He certainly has it available. It's a little one-page fact find, and we need census. He would then send that to me, and we run proposals and designs, and then we'll get on the phone with you and help you present it to your client as well, your prospect as well, and see if that design will work for them, and we'll work it through, and hopefully until we get to one that does. And I'll close with this case. I showed you this one right at the beginning, right, where we got this tax bill down to $50,000. And just a little advertisement for the next WebEx. This is a 5-year plan. We will save them $996,000 when they make 5 years of contributions. When they finish that, they'll now have a little over $2 million in this plan. We will then roll it to a 401k and use the distribution solution strategy to get the money out. And when we get that money out, they will pay a tax bill of $570,000. We saved them $996,000 going in. They'll pay $570,000 on the way out. So we will have saved them at the end of the day $425,000 in taxes, and we will have created, in this case, because we write the insurance on their children, a $48 million legacy for their grandchildren. We will dive into that more deeply on the next call. So with that, I will stop talking now. I'll turn it back to Bill, and I'll be happy if people have questions and he wants to take them and pass them on. I'll be happy to answer them.
Perfect. Mary, that was great. What we're going to do, we have about 4 minutes left. Andrew, do we have time for a question or two before we have the question of the day at the end here?
Yeah, I could squeeze in maybe one here.
Okay, make it a good one then.
All right, let's see. So we have a question that says, what happens when an employee leaves the company? So if it's an employee of a company that does these plans, will there be a surrender charge, or what's the implication of that when an employee leaves?
Okay. So the first question when an employee leaves is, are they vested? Right? There are vesting schedules in these plans. Vesting means that ownership in the benefit. The vesting schedule could be as long as 6 years, or it might be shorter. In a cash balance plan, it must be 3 years. So when that employee leaves, if they're not vested or they're only partially vested, any money that they are not vested in will stay in the plan and be used, either reallocated among the remaining participants or used towards the next year's contribution. It does not leave the plan. It stays in the plan. If they're leaving, whatever money they're vested in will go with them. They can roll that money to an IRA if they don't want to pay immediate tax on it. If there is life insurance in the plan, depending on where they are, there's a couple of choices. So if they're fully vested, that life insurance policy could be distributed to them. We'll just change the ownership to them. They will pay tax on the market value of the policy, a distribution, and they could then keep that policy. They'll have to continue paying premium, or reduce it depending on where they are financially in the policy, but they could keep it for the rest of their lives. If they don't want the policy, it could be surrendered. If they're fully vested, they would get all the cash that was in that policy. If they're not fully vested, some of it might stay in the plan. If it's been written with National Life, they also have an exchange program that's unique to National Life, where that policy could be surrendered in the plan, and National Life will issue that insured a new policy, a guaranteed issue outside the plan for the net amount at risk with no underwriting. And we can change the form of policy if maybe they wanted to change the form of policy. That would be another way to continue the insurance. Now, if there is money in annuities where you might have surrender charges, it can get a little more complicated. Again, if they're fully vested, we can hand them the annuity, no issue with the surrender charges. If they're partially vested, we may have to partial surrender some of the money in that annuity, because we're going to either surrender the contract or distribute it to them with its reduced value. So you could potentially have some surrender charges that might hit on the annuity.
Okay. All right, great. So what I'm sure there's a lot more questions that came in. We have hundreds of people on. So what we're going to do, just obviously type in your question. If you already did, we will get back to every single question with an answer today. So don't worry about that, and then we can always circle Mary back in. And don't forget about the part 2 on May 12th. So same time, May 12th, write that down. And what I want to do now, we have just a couple slides, and then we'll put a bow on this. And also, Mary, thank you so much once again. Phenomenal job. So we appreciate you as always. So real fast, you want to get started, no problem. On our website, we're going to send you a link that will take you right there. And basically, we have 2 links set up there with LSW and Lafayette. And then, of course, we can set up the introduction call. If you have a guy, you have a girl, Mary will get involved with you and help you present the policy and concept to you and your client. So, again, the heavy lifting, no problem, okay? All you have to do is know one person, like I said 3-4 times already. Okay, this was a case study. Actually, the agent's on the phone with us, and I'll just give you a quick example because we don't have much time. This is a business with 4 partners. The agent walked away with a $112,000 commission, which is on the lighter side, okay, just to give you an idea. When I say this could change your year, I mean that. So these, in fact, Mary can tell you that the average target premium is what, 140 to 170? Mary, is that right? I don't know if you're still on.
Yep, pretty much. We usually, because the premiums on these policies range typically from 100,000 up.
Yep. So there you have it. Okay. All right. So this was a podcast. The next slide I did with Mary for 1 hour that will also further educate you on her concept and basically tell you who and where to look for these possible prospects and clients. Andrew, if we can move on to the next slide, that would be great. So real fast, we're going to email this link out so everybody has it today. And then we'll also include past webinars that we did with Mary as well. And then, of course, don't forget the part 2 that's coming up on the next slide here. These are all of the upcoming trainings, IUL term living benefits. We have a special guest speaker. That one's on the 28th. We have a new bonus sales strategy for small business owners on the 5th, and then the part 2 of Mary Reed's presentation focused on distribution solution is on the 12th. Do not forget to be and register to that webinar, 3 p.m., same time. Okay, last slide here. We're going to have our giveaway and our question of the day. So real fast, I hope you were paying attention. This is my Positive Tuesday quote that I want to mention real fast. This was a picture that I actually took from my dashboard in my car. I thought it was amazing, okay, to see what this man did and how he figured things out, right? Despite him being a paraplegic, he works out at my gym, and it's an amazing story. So I just wanted to mention this quote, perfect doesn't exist, but maximizing every opportunity, figuring it out, and making things happen does. There's no more excuses, okay? Perfect example, if you're not comfortable in this part of the market with these larger cases, Okay, we are helping you. You can leverage this great opportunity with Mary, right? And her intelligence. She literally authored 5 books. There's no one that knows this part of the space better than Mary. And now you have a great chance to work with her. So love this quote, love today's training. And now we're going to have our question of the day, and make sure your little fingers are on the keyboard so you could win. Whoever answers first incorrectly takes home the Amazon Fire 8 and the latest copy of Mary Reed's Distribution Solution book. Okay, so you have to tell us, here's the question, the name of the 2 carriers and 2 types of products that Mary uses in this concept. Okay? The name of the 2 carriers and what type of product does she use with each carrier. So the name of the company and the product type, there's 2 of them. You answer correct, you win. Andrew's going to look at all the answers now and see who was first and announce the winner. Andrew, do we have a big winner today?
We do. First correct answer is Benjamin F. Benjamin F. from Florida is the first correct answer.
F like Frank or S like Sam?
F like Frank.
Okay, Benjamin F like Frank. Congratulations. The answer, LSW, IUL, Lafayette Life, Whole Life. Those are the 2 go-tos for Mary Reed's strategy. With that said, look out for our thank you email tonight. We'll get everyone's questions answered, and make sure to register for May 12th, Part 2. Have a great day, great selling, and thank you again, everyone. Take care.